Good afternoon, everyone, and welcome to another edition of Unlock the Stock. We are pleased today to welcome back for the 6th time to Unlock the Stock, Calgro M3. As you know, Unlock the Stock is a platform which is specifically designed for retail investors to gain access to corporate management and to get to know both them and their companies a little bit better. Wikus Lateghan, the CEO, Suri Naika, the CFO, Valdi Joubert, the MD of the Memorial Parks business, and the CEO incumbent, Ben-Pierre Malherbe, join us from Calgro today, and Wikus will take you through a presentation shortly. Unlock the Stock is only possible with our technology partners, Lumi Global. You can visit their website at lumiglobal.com to learn more about Lumi's various online AGM and presentation solutions. Our host today will be the Finance Ghost, who will be facilitating the Q&A session at the end of the presentation. But before we start, there are just a few housekeeping notes. Wikus will take us through a presentation, which will be followed by Q&A. As usual, you can type your questions into the Q&A box, which you'll find at the bottom of your screen. This event is being recorded and will be available on our Unlock the Stock YouTube channel next week. You will see an address when we start the Q&A session, and if you would like to be added to Calgro M3's contact database, please jot down that email address and get in touch with us. Wikus, that is all from my side. You are welcome to share your screen with us and take us through the presentation, please.
Okay. Welcome, everyone. Hope everyone, Vanessa, can you see the presentation?
Yes, it's perfect. Thank you.
Okay. Welcome to everyone on the call. Vanessa, plus Finance Guys, thanks again for the opportunity. Thanks for all the sponsors of this event. I'm going to take you quickly through the results presentation in about 20 minutes. We'll touch on a few things where we see the business currently, where we see the business transforming to, and where we see ourselves ultimately in 3-4 years to come. This will be my last presentation, public presentation from here.
Recording in progress.
I'll take over on the 1st of January from myself. But as you can see, up to end of December, we'll still be busy. And hopefully afterwards, there's still some role for us to play. Thanks for Suri being on the call, as well as Valdi and, of course, Ben-Pierre. Maybe just a quick introduction before I get to the slides. It's been a busy 6 months for sort of business as usual. Our whole idea was to stick to the plan. Our whole idea was to continue to build legacies, changing lives. And we will always remain true to our core in that. In that light, you would have seen that some of the media agencies picked up that it's as at the end of November, for the first time ever, we'll be launching a 1-bedroom apartment at 399,000 Rand again. With a similar finishes to our current product offering and the photos you'll see out throughout the presentation. And the main reason for that is that we've done a lot of work to say there's this big housing backlog, but for some reason, not us nor any of our competitors are capturing the market. What are we missing? And over the last few years, we've done a lot of research in that, and a new small 1-bedroom unit is coming to the market as at the end of November, as well as a 2-bedroom apartment, again, slightly smaller than our current product, for 499,000 Rand. And the whole idea is to really build legacies, changing lives, look at the lower end of the curve. Where's the people that really need a home but cannot afford the home, or just don't stock in their price range? And why that's so important to us, if you go, and I'm going to use Randburg as an example, just because it's close to our offices, but there's similar examples throughout the country. In Randburg, you have this old houses, area called Windsor. People buy up a 3 or 4-bedroom house. There's 3 living areas, dining room, lounge, some sort of third office. They convert everything into rooms, and they rent that house to between 6 and 7 families sharing a single kitchen, a single bathroom, and all of that for between 3,500 and 4,000 Rand. The people that's able to pay that in rent shouldn't be living in those conditions, and hence why it was so important for us to continue to make a difference. So the core message is stick to the plan, and we have stuck to the plan. Ben-Pierre is next to me. There's no strategic change envisaged with him coming in. Yes, of course, there'll be a few operational changes. My way of doing things, my way of managing teams is not his. We've worked together. We said this morning, from 2008 to 2017. He actually left the board as non-executive only in 2019. We know each other well. We know each other's strengths is. We know how each work. But also what Calgro has done over the years is, from a strategic perspective, is we never just change strategy. We go to our largest shareholders, of which BNP is still one, as well as Dion Stein, one of the other founding members, and we get everyone's buy-in and get everyone's thought on it. So I think it's an easy transition, this. Core messages, we've got an adaptable pipeline. What that means is that we service land, and very late in the cycle, we can decide who we build for in our development business, and the same in our Memorial Park business. We create these big sections, but we can, if there's a bigger demand for family estates, we can build more family estates. If there's bigger demand for single graves, we can do more single graves. A lot of growth expected, organically and acquisitions. The acquisitions are actually in the past. You'll see we've enlarged our Vleerhof project. I'll touch on that a bit later, as well as our Bankenveld project. And then organic growth, we spoke about a lot over the last 3-4 years, always maximizing return on the current projects. And why we can do that is because we've got a good, strong balance sheet. So consider implementation. I'm going to start right at the right-hand side. You need cash for everything. Liquidity, aka cash flow, is key. That gives us the opportunity to do capital allocation, because there is a capital to allocate. We're focusing on sales in both of our businesses and growing our market share. All in an endeavor for sustainable growth, and always focusing more on sustainability and risk than necessarily making money. Which brings me to this slide. 869 units handed over during the period. You'll see that the media got hold of to say there's been a revenue drop. It's almost been the headline in most instances, which is actually a wrong illustration of where we are. Yes, there have been a revenue drop, but not as severe, from 688 million to 507 million, because you have to look at our joint ventures. And if you look down further in the income statement, the joint ventures contribution substantially increased, where the revenue in our Southfields JV increased from 23 million to 175 million. So if you look at that and you compare that total numbers, you're actually just down 3.8%. Granted, Memorial Parks performed exceptionally well. I'll get to that just now. So if you reverse Memorial Parks increase, developments actually dropped with 10%. If you look at our 4% price increase, 14%. And that's just the market stuff out there. The consumer is under severe pressure. But I must compliment the banks. All the major banks have continued to play their role, and our conversion to bankable or giving a bond from sold have not decreased over the last 2 years. It's still very, very consistent. Yes, we have to sell a lot more, but we pre-screen, and that's where the clients drop off. It's just the consumer is under pressure. All of this, if you look at the revenue, dropped to a GP margin of 29%. It looks on the high side. It's above our range of our target range of 20-25. Developments contributing 27%, and Memorial Parks, just because of the high increase in revenue, 57% in the terms of the GP margin. A blended margin of 29%, but I can report, and you'll see it's explicit stated in our results, in the short to medium term, we expect that trend to continue. A further 2% save in administrative expenses. I say further, for the full year up to February 2024, that dropped 4.8%. And if you look at, I just looked back the other night, 2015 August, our administrative expenses for the 6 months was 55 million. It's now 49 million for the comparable 6 months, 10 years later. So over a 10-year period of time, I focus on rather saving money than necessarily, well, saving money while focusing on good revenue, than rather just chasing revenue at all cost, have resulted in a 10.9% in rand terms saving, unescalated, in our administrative expenses. Look at the net effect of that. Already spoke about the JV contribution, gave rise to an increase of 28.55% to 101.4 cents a share, both earnings as well as headline earnings. Quite a solid increase, and it also shows you our capital allocation towards share buybacks in the previous periods are really benefiting the group. Net debt to equity stable at 0.63. Loan to value, that's how the REITs or the residential funds calculated, 30.4, so also in line. Currently 1,539 units under construction, which we quite explicitly stated. Most of them, maybe just to qualify, 51% is also most, but a large part of that will be handed over in the second 6 months, already predicting some growth for the second 6 months. 138 million spent on infrastructure. Now that number is important to us. And the reason for that is if we later get to Bankenveld, you'll see that we intend spending 150 million over the next 18 months in Bankenveld. And the Current 6 months, we spent 138 million to get Fleurhof, Jabulani, Ballard, as well as Scottsdene to a point of 98% long lead items. So basically your bulk and link, your long capital cycles invested. So from here, we can only focus on our new Bankenveld project, and there's not other projects. That's a requirement for big capital investment. If you look at the previous year, we spent 300 to 15 million on that. But what it also indicates to you, on top of the spend, is we had to get this out of the way so that all capital can be focused on Bankenveld. It also shows you that we've been able to spend a lot of money from cash from operations in infrastructure. So the 150 million from Bankenveld don't need to be raised in additional capital. 2,609 units serviced. We're busy servicing a further 2,400 units, of which 1,592 will get under construction within the next 6 months or up to end of February. So maybe just a bit of a recap on why that number is so important. We say there's 869 handed over. We say 1,539 under construction, of which a large part will be handed over in the second 6 months. Let's just assume 2/3 get handed over. At least 540 units will be carried over. You add that to 1,592. Under construction, 1 March will be 2,100. We started the year with 1,719, I think. So you can already see the growth, the capital being in place, and how this pipeline will unravel. No dividends, interim dividends being declared. We only have a dividend policy of 5% of HEPS. And at this stage, all indications are that the board will honor the commitment and the policy as at the end of May. Your NAV increased to the first time over 14 Rand with 6.32%. Again, why the number is significant, if you rewind 4.5 years to February 2020, before COVID, that number was 6.36 Rand. So a combined increase, combined increase of 19, just short of 20% per annum. Capitalized, and then for the first time, we're very proud to announce that Memorial Park, the purpose of that business has always been risk. So why that's important, for the first time it covered the administrative expenses. So the whole risk motivation behind putting that business in place to say that business needs to cater for all administrative expenses, not only of itself, but for the whole group. So that if developments, because it's cyclical by nature, it's risky by nature, in downward cycles, you do not have pressure on your administrative expenses, and that we reach ahead of target. And the next target, of course, is to go also cover the finance cost, but for that we'll need a few more parks. So a bit of growth to get there. If you look at these numbers, administrative costs and interest is roughly aligned Rand for Rand. So therefore the revenue effectively will have to double to get to that point. Just the softer issues, 47% women, currently slightly down in terms of where the staff complement is. Target of 50% remain in place. That middle number, the amount of our own staff with training, is important to us. We're still level 1 empowerment contributor, and we're still ISO registered. And our CSI, mostly going into educational facilities. Maybe this picture this is 32 Pine in Fourways, just behind the Cedar Square Mall. We're developing, and if you look at the finishes in this house, the face brick, the roof structuring, the water, the JoJo tanks, the solar panels, the swimming pool, the clubhouses, the Astrosphere force fields, you'll see that's a continued theme throughout even our products we put in the market currently at our average sales price of 636,000 Rand. Developments, just to touch on this business play from fully subsidized, currently no public sector housing. However, remember, we always said it's not our intention to move completely away from public sector, but we have no reliance on them. So we'll focus on the man on the street, the private sector. Whenever government's got funding, that will be an add-on up to effectively first government rentals, social housing rentals, FLISP housing, the gap, where someone is too poor to qualify for a government subsidized house and too rich to qualify for free house and too poor to qualify for end user loan. Affordable housing, and then the higher end, we're just trading out. And again, if you look at the pictures, your right-hand picture, that is 32 Pines inside. In the left-hand, far left-hand picture, that is units in Bella Loft. That same unit we sell in South Hills for 599,000 Rand. And if you look at exactly the same kitchens, exactly the same taps, plug fittings, light fittings, everything. So that finishing flowing through just because of our scale. That's flare off, extension 39. You can already see the infrastructure in the background, but on the next picture, you'll see it clearer. Currently in flare off, we've got 9 out of 32 sectional title units, infrastructure installed. We commence with 260 units on them. That's all the smaller units, 399 and 499. We're testing the market, and we'll roll it out to other projects, as well as 72 freestanding houses. The rest of the information on this slide I already touched on. The numbers mostly I touch on. Pipeline currently sitting at 33 billion with the addition of our Bankenveld project and 37,000 units. So you'll see our pipeline increase of 16,000 units. So the question is, how did you add Bankenveld 20 and only net increase of 16? We also added more land towards Fleurhof, 2,500, 20,000, and then we put a Witpoortjie. Well, we actually have it quite close to a concluded deal on our Witpoortjie project. Bankenveld. Bankenveld is not about the numbers that's on the slide, so I'll quickly touch on it. Bankenveld property transferred, the land have been paid in September. The first phase infrastructure to service just short of 6,000 units, with very limited infrastructure to service up to 10,000 units is 250 million. We get 60% of the benefit of the project, so we have to pay 150 million of it. Already touched it, we've got ample capital to do so. But what this project will do is, this is land between the M1 and the M3, the old Wits property. That will it's not about the 30,000 families that will be staying there, ultimately, 20 to 30,000. It's not about everyone that will work there in the retail, commercial, industrial. It's not about the kids that go for the education facilities. This project must set new boundaries in terms of where South African housing delivery is going to. It must set new standards. We must really build legacies and change lives. We must go into Alex, and we are, to take people off the street. We'll train them into artisans. They will get jobs at ours. And generally, only currently less than 50% of all the people we train actually end up working for us. Because we do this on bulk, we limit it in terms of rates. They can get a bit, it's more paying to come and paint someone's house in Bryanston than to paint for Calgro. But it's still fine because we've contributed towards the economic environment. We've contributed towards the economy and the growth. We must take the people off the streets. If you take the people off the streets, you train them as artisans, you give them a job. They can look after their own kids. They can pay for the kids to have a proper education so the kids don't hang around on the street. You immediately reduce crime because people have a job so they can pay for their own food. They can look after their own elderly. There's a lot of indirect jobs being created, because we'll set them up into SMMEs, which will generate more work for them and work in a structured environment. And ultimately, they should be able to afford the housing on our project. So this is about upliftment. After 260 hectares, 34% of this project will be utilized for infrastructure, major infrastructure, linking Marlborough with Woodmead, new traffic routes, linking Limborough Park on the other side of the highway with an undercarry under the highway with Woodmead, making access to Sandton easier. This project is primarily located right in the middle between Sandton and Waterfall. So even if Waterfall achieves its goal to be the new Sandton, we're still on the doorstep, and we bring affordable housing to the doorstep of Sandton and Waterfall, where people don't have to spend as much time and money in traffic. People can have better lifestyles. It's very important to us. Pipeline. On the left-hand side, there's projects we put up for sale. Why? Not because they're necessarily bad projects, but because they don't fit into the current strategy. Umhlanga, KZN, exiting. Witpoortjie is a very good project, but Witpoortjie, all our projects, the rest, I've commented earlier, the major infrastructure has been installed, so there's no big capital checks required to roll out the balance of the projects. Between Fleurhof, Ballard, and Jabulani, you'll see that it's stated in the results. We have a further 100 million to spend to unlock a further 12,000 units. That's 8,300 per unit. Small check size for big returns. So lots of liquidity locked up in this pipeline. Witpoortjie need a big check. We'll rather put the money to Bankenveld. So we put Witpoortjie up for sale. The due diligence process by the prospective buyers underway. KwaNobuhle, Eastern Cape. We want to focus on 2 provinces, and actually more specifically Johannesburg, City of Cape Town, and then the mid to highland that we've always had. Trade out, Jabulani, Laviniville, Scottsdene, and mid to high. So what trade out means is complete the projects. The likes of Jabulani and 32 Pine would have been completed in that period anyway, next 30 to 36 months. We've invested capital in Scottsdene and Laviniville to fast track that rollout. Again, why? To get to our long-term goal. Focusing on 5 projects, maximum of 6, Bellof, Frederick, Fleurhof, Southfields, Bankenveld, and just the last properties. And ultimately, Bankenveld only have 42 to 48 months horizon still left, so we need to add properties to Cape Town, but we will not do it at any cost. If it doesn't work within our model, we'll make do without that diversification. Moral Parks, again, uplifting people, dignified burial spaces. I'm not going to go through the numbers, I already touched on it. 56.7% gross profit margin, but more importantly on this slide, you'll see that 48% hit the bottom line. So that was quite important. Banking's up from 34 to 52 million, and our labor offering 21 to 40. So that book is quite becoming bigger, so more forecastability on the cash flows. Pipeline of 2.7 billion or 120,000 opportunities. Financial review and summary. Revenue decreased to 507 from 688, but not a true reflection. You have to add the 23 growth in the JVs to 175. GP margin up from 28% to 29%, mostly driven by Memorial Park, 57%. Administrative costs a further saving, and actually it nearly 10.9% down over the last 10 years in rand terms. Major contribution further down from our joint ventures resulted on the net profit, if you include the share buybacks, being up 28% and the highest ever 6 months profit. Balance sheet, cash on hand increased from 122 million to 168 million, so a healthy increase. Yes, our debt also increased short term with 100 million. However, post the half year in, we already settled 50 million of that debt, and we'll be settling 48 million. We actually queued it this morning, 48 million further end of this month. Why? To get back to that roughly 950 million debt level. The only reason we drawn additional facilities, we were uncertain about the timing of cash flows. If you read the results, you'll see there's a 200 million that came in the first 2 weeks of September. We just got our timing of our transfers and our cash flow slightly wrong, and we were cautioned of that because we had to pay for Bankenveld. But debt levels back where they were. Covenants well within the covenants, so no risk associated to the balance sheet. And to my earlier point, the balance sheet is actually very liquid, just because all the current continuing long-term projects, the long-term infrastructures have already been installed, barring Bankenveld, which we can focus on from here onwards. So where do we see the future? We'll be focusing on diversification. We already said enough. Growth. Where does the growth come from? Fleurhof, we've got all the service stands. Southfields, we've got service stand. Bello, we've got service stand. And our sales, yes, are under pressure, but we're still selling in this constrained market, as well as for the first time in 3 years, public sector seem to also have money they want to give us for more units. Cash generation positive, even though we invested heavily into infrastructure in the last 2 years. Memorial Park confidence, I think the numbers speak for itself. Our product offering is good. We believe we're the best value for money offering. You would have seen it throughout the pictures in the presentation. We believe we understand the lower LSM markets where we're playing. Financial strength, we've got the balance sheet. Digital innovation, we'll always try and include that and see how we can drive more efficiencies. Profit outlook, I spoke about the numbers, the number of units of 1,539 under construction, a further 5,592 commencing or in the process of commencing. And of course, capital allocation between dividends, share buybacks, as well as growth in the business while managing risk. While managing risk is important. In conclusion, I'm going back to the first slide I started with. Stick to the plan, and this plan will not change. And for now, I want to start on the right-hand side of this picture. Because we built the balance sheet to the strongest balance sheet ever, because we've got liquidity, because we've got cash flow, because we have projects that's serviced, where every sale we liquidate out our historic land price, and that's why development, sorry, I haven't touched on that, why development's margin is growing, even though the sales are under pressure, because we've never revalued any of our land. Our land is still sitting at historic cost. Our infrastructure is sitting at historic cost. So that's now that additional valuation. If you go and fair value this land, is now coming through the gross profit margin. and we propose that to continue to be above the target range for the next for the short to medium term. So because we built this very liquid, very cash generative balance sheet, we're able to grow the middle. I already said no acquisitions planned except for Cape Town, so it will be organically working the projects hard. And then last on the left-hand side, we've got an adaptable pipeline. We're very late in the cycle. We can decide who we build for. And if you look at our units, if you look at the pictures we produced throughout the presentation, just going to go back. This unit in Jabulani, we're selling for 659,000 Rand. Look at the finishes. I coincidentally went stand-up's offices earlier today, and I said, exactly this cupboards they have in their fancy boardroom. Why can we do that? Because of scale. But because we can do that, the value for money offering is there, the banks are supporting us with end-user finance, and the clients see this as an aspirational buy. So very important that we continue to focus it, and we believe we can airdrop this product from Jabulani, from Fair, from Southfields into much more affluent areas and still have and achieve much higher sales prices. So we're really uplifting people, sticking to our goal of building legacies, changing lives. Thank you.
Thanks so much, Vickers, for that. We're going to go into the Q&A session now. And as a reminder, if you would pop your questions into the chat function or the Q&A box at the bottom of your screen, please address that to the finance ghost, because he will be taking the Q&A session today. So with that, over to you, the ghost.
Thank you, Vanessa. Welcome, everyone. I see a few new names on the list. So this is your first Unlock the Stock. Thank you for joining us. It's certainly not Calgro's first Unlock the Stock. There's been quite a few for you guys. So thank you for the ongoing support. And I think just the ongoing openness with the markets and level of communication, which is awesome. Obviously, you know, question one, there's no prizes for guessing what that's going to be. So with the news dropping of Valdi Vickers leaving the group and a change in management, that's obviously, I think, the thing we need to address, you know, right up the top. You guys have been with the group for a long time. It's been quite a journey and a tough time in South Africa. And obviously investors and prospective investors curious to know, I think two things actually. There's two elements to the question, which is one, you know, where are you guys going? What are you doing? Why are you leaving? That's the obvious one. But then also in terms of Ben Pierre, you coming back into the group, you know, I got a question in my DMs around, it's always interesting to see an executive kind of coming back as opposed to maybe someone coming up from inside. So it's actually a two-sided question. First one is what you guys are up to and why you're leaving. And the second is, Ben Pierre, just, you know, the decision around you coming back to the group, just to give investors some understanding around the plan there.
I'll start with why we're leaving, but I'll have to comment, at least Ben Pierre is younger than our counterparts at Pick n Pay coming back.
It's a well-chosen benchmark. It's a well-chosen benchmark.
Yeah, I think there's nothing untoward. I've heard a few times, even from some media agencies, that they're waiting for the announcement in January where we're going. So I said, I'm very glad that someone knows where we're going, because we don't. So I think after, in my case, 16.5 years, Valdi's case, 13 years, there's a few reasons that got us here. Firstly, I think, and I've said a few times over the last 3-4 years, I've tried to prepare the market that I won't be around forever. And the reason for that is I believe you become almost stuck in your ways. And we've got a very, and I'll stick my neck out. I believe we've got the best balanced development management team in the country. Town planners, architects, development managers. We might not have the best individuals, but we get the best team on a balanced approach. And they come with innovative ideas, especially if there's challenges. And this type of business always have challenges. And then you almost say, but let's just go my way, because we've always done it like it. It worked. And we've been through really challenging times, as per your comment. And I don't think that's good for the business. So I think it's time. I mean, Ben Pierre came in, and he's been in the office 6 weeks now. He walked into my office about 2 weeks ago, and he made a comment, and why don't we just shift that this person to that, because it actually speaks to their core strengths. And I look at it and I think, but it's so logic. I just never saw it. So I think it's good for the business that you have management changes. In this case, I think we're very beneficial with Ben Pierre having all the institutional knowledge. He's a founding member, he's still a strong shareholder. He was here when we done the first presentation for Bankenveld. So it's not a surprise to him. That's why he can so easily agree to the strategy. And per my earlier comment, we kept him abreast of the strategy. In terms of myself and Valdi, we're actually going on our own. So I think by now the market would have realized that we're going together. I think I was the first one that made the call, and then Baldy decided to join. We will still be in property. We will still be making a difference. We're not going into competition of Calgro, just to be clear. More the rental side of it. Maybe more the unregulated side. Maybe after all these years, I need a bit of freedom. I always say I'm the conservative one and he's the blue sky one. So maybe he needs a bit of freedom. But it's just time. So nothing untoward. We're still available if the group needs us for short-term things. But we're just going to take some time off. My kids are now at this age. I attended my daughter's first dance competition this year 2-3 weeks ago. And my wife said to me, "You've still been on the phone half the time." It's not fair. I've got young kids and I want to spend more time with them and see where life takes me. Nothing similar for Baldy, unless you want to add.
I think similar.
Yeah, look, I think it's a great answer. I mean, I also have kids, so I understand where it's coming from. I'll let Ben-Pierre talk now, but I just wanted to ask, does Valdi dye his hair or did he just not work as hard as you all these years, Vickers? Like, what is the secret to his youthfulness? I'm trying to understand how he's leaving. Is that the thing? Okay, well, then fair enough. So Ben-Pierre, welcome then back to Calgro. And I guess, I don't know if you want to add anything to Vickers' answer there.
Yeah, I think just for starters, I can understand where Vickers is coming from. When I stepped away as CEO in 2017, I was exactly where he is now. And you get to a stage after 10 years in the listed environment, it takes a toll. And I was fortunate enough to be able to walk away and say, see my kids go through high school, because it's unfortunately there now. So I can understand why a call like that has been made. And with me coming back versus the internal capacity we've got, I agree with Vickers. And spending time in the office for the last 6 months, we've got an extremely strong team here to keep operations going. So I think the reason why I agreed to come back is to say we need to get the next generation through there and get them to a level where they can take over from Vickers and Valdi. And yes, they are leaving a big hole. There's no question about that. And I just wanted to make sure that the guys come in here, has got that strategic experience, more than the operational stuff. The operational stuff, Vickers and Valdi is leaving the company in a great state. The company is stable. They came through a tough time in 2019 and 20, and they're big enough to admit that. And I think the state of the company currently is actually what created this problem. They got to a stage where they're comfortable to step back and say, someone else's turn. And I think mine was just, when I came back, I gave the board a commitment. You won't see another announcement in the next 6 months. So I gave them a commitment and say, I'll be here until I'm comfortable that we can hand over to the new generation and take this to the next level. But on strategy, I think we're on the same page of the strategy. Unfortunately, I don't have to come back and put a new strategy for a turnaround. The company is healthy. They've been doing extremely well over the last couple of, not just the last period, but the last couple of periods, with 5 years of great growth in the group. So I'm in a fortunate position where it's a question of just keeping it going for now.
My last comment is I thought Sayuri can take over, but the board requested that you have to be grey to become CEO. So at least we got the grey Ben-Pierre back. So Sayuri first have to get grey before they can hand it to her.
That's also why Valdi had to leave with you, right? Because he couldn't get the promotion.
Correct, yes.
Okay, so I think let's move on from the management changes. I mean, obviously that was top of mind for everyone. So thank you for the candid answer. I mean, you know, anyone who's run a business and had kids understands exactly what that life is like. So I don't think anyone can really point any fingers there. You guys have been there a long time, and congrats on taking the step. I think let's talk strategy now, obviously, and I kind of want to take it really high level and just go to all the euphoria in South Africa at the moment, the GNU, the stock prices all ran. Some stuff seems to be coming through a little bit slowly. You know, if I read results at like, you know, I'll just mention PPC, for example, it doesn't look like there's huge activity there just yet, etc. So just a sense from you guys, you know, just your views on just prospects in South Africa. Do you think it's looking that much better on the ground? Because it's easy for the headlines to make a big splash and it's also lovely and everything. From your guys' perspective, bottom up, you know, are you seeing that starting to come through, whether it's in, I don't know, your engagements with government or whatever the case may be?
Okay, I'll start and then my colleagues can fill the gaps. Let's start with the consumer, because I think that's where we are focused. Government is added, and I'll get to that. The consumer is under a lot more pressure than what I think the market is keen to acknowledge. I think they know that, but they don't want to freely acknowledge it. 25 basis points in interest rate reduction done nothing. I think it got everyone's hopes off, and then they realized on a 600,000 rand bond, that's 250 rand. So it done nothing for the housing market. We need to get to a combined 100 basis points, which is starting to make 920 rand a month difference, which is a larger number. And with that comes a lot of other things, because you're also going over this period where the salary increases. So it's not only interest rate reduction, salary increase and everything. And I think businesses are starting to be more positive about the future, and what it does if business are more positive, in a position where Calgro is, where we can commit the capital, because we do see the growth, not now, but in future. But if we start committing more capital, we create more jobs. If we create more jobs, the economic environment's more stable and stimulated, and therefore you will start seeing growth. So we need to get to 100 basis points. We forecast another 25 for this year, and hopefully another quick consecutive 25 basis points next year. And then after that, I think a lot can be said where the US is. And that, unfortunately, US election can still have a big impact on this as well. So the consumer being under more pressure, you even see it in a Moore Park business. Where did the pre-sales go? To the labor offering. You can see the growth in the labor offering, not to the cash sales. So cash sales were driven by on-demand sales, where a loved one has passed away and they're looking for a grave. So that's important to note. So I think the turnaround is going to take a lot longer than we expect in South Africa. And just there's some interesting statistics now to ask a question, where if you look at car sales, the housing market, if car sales start slowing down, the housing market generally slows down roughly 9 months post that. If the car sales start picking up, the housing market start recovering roughly 9 months post that. We haven't seen a significant impact yet on the car sale market. So I think it's further out, but there's signs of positiveness. How we're countering it is we kept bringing in that 399,000 and that 499,000 products, which is playing to the lower LSM, making it more affordable. And if we then get the interest rate reductions on top of that, we just broadened our market. And hence why we are quite bullish on the growth for the short, medium term. On the development business and Memorial Parks, I said earlier, I think it's starting to play this risk role where it's now become a brand. It almost sells itself. And that's very important. There was a test done about 6 months ago, where they switched one of the parks marketing off for 2 months, just to see what the effect is. They didn't grow during that period, but the sales also didn't go backwards. We showed that the brand is starting to be acknowledged. And it shows you that that's such a cultural business. So that's good. If you look at the GNU, specifically government interactions, there's a big drive towards local elections in 2026. So there's big commitment by governments to make a real impact. But I think so that's on the one side. The GNU specifically, and now I must be sensitive, I think the more coalition-driven governments on local government level, the impact of that is that in the past, you had a majority party and smaller parties. If you have, if you don't accommodate the communities well enough, you'll be out of a job in the next cycle. And still, they want to be popular to get jobs. Unfortunately, that's true. Where now they're in coalitions or in GNU, and they can start making the hard calls to say, community, you want another police station, but there is a police station 1.2 kilometers away. No, we're rather putting this money to upgrading the sewer or the water infrastructure, because they know that even if that community go and vote for another party, because of the coalition or the GNU, they'll still have a job. And now we can start making more of the hard calls on that level. And I think that's having a positive impact on South Africa and specifically our projects. So it's not necessarily, there's no more money in the system currently to do more. They still have to make do with very small budgets, because the African economy from a government perspective, cash flow is under pressure. But I believe they're looking at private sector, ourselves, for instance, more to help them, assist them, but they're prepared to take the hard stance against the community, which actually allows us to invest and unlock the infrastructure.
Thank you. That was, yeah, no, go ahead. Okay.
So Rech, I can just add to that. So moving away a little bit from the macro environment, if you look at the project itself, the group is in a fortunate position where some of these projects have been coming for a long time. And if you look at Fleurhof, I mean, Fleurhof we bought that property in 2008. If you look at the sales currently out there, we're working with historic land costs. We're working with infrastructure cost that was created over the last 15 years. The water reservoir was constructed a long time ago. The bulk upgrades for the intersections and the substations and the switching stations has all been constructed in the past. So we're in a fortunate position where as soon as the pressure comes back to delivery again, we've got products on the ground that's ready for implementation. And I think that's a big advantage we're currently sitting on. It's not something to say appetite is coming back. There's not a switch where you switch appetite on and off. But if it comes back there, we're in a position because we've got service land, we've got infrastructure available. We're in a position to say, yes, we're happy to play in that space again, because it's not something we've got to go and build capacity and buy properties to get back in that space. It's a land that we own.
Perfect, thank you. And a very nice cautionary tale there on how long the South African recovery will take. So I really enjoyed the comment there about watching the car market relative to housing market. It's like a hierarchy of needs, right? And it's, you know, how durable the goods are. Like when you start to have a little bit more money in your budget. So my theory is we'll see it first in the clothing retailers. I have no idea if that's going to be how it plays out or not, but logically, as soon as you start having a bit more money, you know, you were already buying food. Like, what's next?
You are correct. You first said in the retailers, but there's a lot of statistics that show that 9-month lag either side. So
yeah, it's going to be very interesting. It's a great stat. Thank you for sharing it. I think let's talk a little bit around some of the infrastructure, for example. So it looks like a big part of the gross margin uplift in this latest result was just in the way of the development mix. And, you know, there's certain projects where there's historical infrastructure, or my understanding at least, it's already there. Then you go and sell a whole lot of units. So you're not building as much infrastructure linked to a unit. A lot of that infrastructure is at historical cost, and that drives gross margin. I just want to confirm some of that thinking and understanding. Siri, that might be a question for you. I'm not sure who's going to take it, but I think for investors to just understand like the disaggregation of revenue, you know, you've got infrastructure as a separate line item, like how that actually works in practice, and then what that means for gross margins. I think it's quite important for everyone to understand that, because the gross margin was a big feature of this result, of course.
Yeah, so I'll answer it broadly. I'm going to use Fleur for example, just because Ben Pierre touched on. We acquired in 2008. We then installed a lot of the bulk infrastructure over the last few years. So the infrastructure we installed in this period, we're actually not going to benefit from now. We'll benefit from in 3 years, just out of interest. The reason it was installed now is to get it out of the way so that we can focus all our human capital infrastructure teams as well as our financial capital on Bankenveld and make sure we get that right. And then there's just this aggregation. So the GP margin is driven by historic cost. And I touched on it earlier to say between Fleurhof, Jabulani and Ballard, there's 100 million left for another 12,000 units. So 100 million cost is spent, where your general bulk and link cost is up to 50,000-60,000 rand per opportunity. So that cost was previously spent, and the longer it is post the installation, the bigger the GP margin effect. And if you look at Bankenveld start, Bankenveld will now start with new infrastructure. That margins from where it go will be in the target range or even slightly above it. And the reason for that is we're benefiting from Waterfall development that was first. We installed a lot of the area requirements, which we don't have to go back to. And then the top structure, and I said in the main presentation, and sorry, I didn't touch on it today. On Bankenveld, we're actually considering, and there's no decision made yet, to not to develop all 20 to 30,000 houses ourselves. Actually install the bulk and link, install the internal infrastructure, and then and do some units. So it's not mutually exclusive, but then potentially sell some service land to some of the other developers who don't have the balance sheet and the banking backup to go and install these long lead items. Because at that point, most of your GP margins already generated. And we actually just building the top structure to ignite or generate the revenue and the cash. Because there's a bigger market that want completed houses. But there is a pot of developers that, as I said, don't have the capital means. And that's why we always said the barrier to entry is quite high. Now, we also don't want to create too much competition for ourselves. So it's sensitive, but you also have to create the aspirational value of the project. But if it works on Bankenveld, we might even roll it out to the later sections of Fleurhof, by way of example. To say we service 2,000 units and 500 of them we sell as service stand. we get our money back for the infrastructure quicker, plus we generate some margin, and your return on capital actually pick up. So that's just why we disaggregate it.
Yeah, I was really glad you touched on the return on capital point at the end there, because I was going to say the historical infrastructure is great for gross margin. It's not great for return on capital. And the other way around, which is to say, well, we built infrastructure and we sold it straight away, might not be amazing for gross margin, but it's better for return on capital, right? So it's that balancing act. And that's what you guys have to think about, along with a billion other things in terms of every single project.
But I think it speaks to Ben Pierce's earlier comment to say we can actually now capitalize if the economic environment starts changing quickly because we have service land. If you only have raw land, it takes you 18 to 25 months to get the first phase infrastructure in, and you actually might miss the cycle to some extent.
Yeah, that absolutely makes sense. Thank you. I want to ask you something around just the project rationalization in the group and the concentration. And I think when people have concentration in a business, it speaks to confidence, because you've got to be sure that what you're concentrating on is going to work, right? I mean, you're effectively not as diversified. It's like any equity portfolio. If you're very concentrated, you're high conviction. So presumably you are very high conviction on what you're doing. The things you're letting go of are not, fit for strategy. I guess I just wanted to say, that kind of talks to a confidence point, and that's the strategy now, right? Is to go and say, we've got a few projects that we believe are really good, and over the next few years, we're going to show you just how good, and kind of watch this space. I mean, that's very much the way your strategy is developed. It's very different to having this overly diversified thing across the country.
Also, I think it speaks to human capital. And when we decided that we're going to divest of some of the projects and this core of 5 to 6 projects, one of the main objectives was how do we best capitalize on our human capital? How do we get our best teams to focus on the bigger projects? Because doing La Vie Nouvelle, our retirement estate, which you'll see one of them, we got trading out, we're actually throwing money to trade out, and that's what is currently working. To manage that project, which generates you potentially 50 million revenue a year, is exactly the same amount of work and effort as what Fleurhof is that generates you 400 million a year or 500 million a year in revenue. So how do you focus that? And that's mostly why the mid to high and doesn't make sense. Umhlanga, if you look at the divesting, is very specific towards KZN. Wannebugle, Eastern Cape plus capital installation, capital cost, and then Witpoortjie, the only reason we're divesting is it needs a big capital check, and we'd rather put the money to where our focus is. But you are correct that if you're less diversified, that is a risk. But what you have to remember, we might only now focus on Bankenveld, and we never, and I said in the main presentation, one of our main concerns, that's why we're adding land next to Fleurhof, is that Bankenveld must never be more than 50% of your revenue. Because Calgro nearly fell over in 2017-18 because we had 76% of our revenue being switched off by the invasions and the shortage of power within 4 weeks. And we should never go back to that risk profile. But what you have, sorry, that's Fleurhof and versus Bankenveld versus Southwest, and that's why the focus is 5 to 6 projects and not only 2. But on every project, we're playing from government fully subsidized, government rentals, social housing, FLISP housing, gap housing, affordable housing, and even in Fleurhof these days, the affordable housing goes up to 1.2 million, in Southwest up to 1.5 million. So effectively, if you look at the monthly salary you need to earn those houses, we're going from 0, fully subsidized, right up to own a 1.5 million rand house. You need a combined household income touching 50,000 rand. So catering for a very diversified client base on every project. And that's rather how we look at diversification in project specific, because you just need so much more resources, then administrative cost lines start running away. And all the benefit you're getting, you're just working harder to make the same money because admin costs eats the extra profits.
That's the old story of diversification, diversification. And I think when you're running an equity portfolio, diversification is good. But when you're running a business, you can spread too thin. I love that point you raised, that you're working harder to make the same money. I think most people who have run a business in some form will, relate to some of that. I know I can certainly. So that's good insight there. Just talking to the memorial park. So I received a question just around the lay-bys, just some of the details around that, over how many months, any initiatives that you might be thinking of to change that. And, also how many additional parks might be available in the market. So there's quite a lot of interest in that side of the business. Valdi, that's typically you. So I'm guessing you're going to jump in there. So just any more details you're happy to give around the memorial parks, the lay-by strategy, how many more you might be building, etc.
Yeah. So I think from a labor offering, Vickers sort of touched on it in the beginning. I think there's been a definite shift that we've seen in the last 12 months or so, where there's definitely more people taking up a lay-by from a reservation perspective than paying the amount cash. Now, practically, if you think about it, if you take something like a Rech, an entry-level grave, there's 34,000 currently. There's very few people that have the means to go and swipe a credit card for 34,000 to buy a grave, to buy a grave for somewhere for future. But if you put a product in the market where they pay just over 1,000 Rand, that's still doable. Still expensive, and I'll go back there now. So the lay-bys gives you an option to effectively pay it off over a period between 3 and 24 months. We've sort of capped it at 24 because we don't charge interest. The moment you start going out further than that, your cost of capital really eats your life because you're effectively selling it at 2 years ago's prices at that point. We only recognize revenue once we've received the full purchase price. So to date, I think there's about 14 or so odd million Rand in revenue, not for the period in total that we've recognized on it. And then maybe just to clarify, this 40 million that we're reporting in active lay-bys, that is actually lay-bys that are active currently. They're in good standing, they're paid up, not in arrears. So that book has really grown quite substantially over the last call it year or so even. Our default rate that we're seeing on it is roughly about 8%, which we believe is very low. So clients are actually, they are paying quite diligently, and that adds a nice dynamic to memorial parks, because now within a business that is really defensive in nature, you've got this stable stream of income on a monthly basis that you can bank on, and everything that you sell on top of that is almost really the cream. So we're focusing on from a strategic perspective, we are focusing more towards market awareness and getting the burials on that side. So the focus is burials, and then the second leg is then lay-by transactions, and those two complement each other quite nicely. Now, you'll see for the first time ever, one of the goals has always been that memorial parks cash flow needs to cover the group overheads, and we actually managed to do it in the 6 months, and I think it's even been a better 6 months than we anticipated ourselves. It was a 5-year goal, and I think, well, it was a 5-year goal which we kept moving. It was always 5 years, and then at some point we said, hey, we've got to peg this thing now. So it's been 3 years since since we pegged it. So that's a fantastic hurdle for us. It really helps the group from a security perspective. And then I think the next step for us logically is it needs to cover the interest bill as well. And as Vic has mentioned, that's probably about a doubling of the business from where it is currently. I think it will be very challenging to get to that point with just the parks that you currently have, because there's an inherent limitation if you look at a park where people tend to bury at a park that live and have family in a specific vicinity of it. So it's very seldom that you're going to find someone staying in Hammanskraal that's going to drive to Nasrec to go and bury. It's too far, it's too costly. So there's an inherent limitation of how big these parks can grow, or what pace they can grow to. So you're going to have to add parks at some point. So we've got 3 parks that we have currently, which can still contribute. So there's quite a lot of scope with the existing parks and the existing stock that we've got. We've got Bloemfontein that has been picking up actually quite nicely over the last 2 months. Again, touch wood, I hope it continues. So that's one that can come on stream that can have a significant contribution. Inokatula in Springs is still slow. We still got some work to do there. And then Rustenburg is under development. It's currently paused. Maybe just to touch, we've had a lot of questions on what the regulatory delays are that we've been experiencing. So we bought the park with rights. And as part of that process, when you do a town planning application, you get burial rights for a cemetery. You have to do an ROD, which is environmental approval, which gives you a certain period of time in which to activate it when you start the activities on site. But you have to notify the department. And the owner that we bought it from, he did not notify the department. And we can prove through Google Earth images that he actually did start in that period. And the question at that point was just, guys, we can go into a legal battle with Rustenburg now, and we can go fight them, and it's probably going to take 6 months or a year with a certain amount of cost, or we could just redo an EIA, which we are, nothing's 100% certain, but we're very certain that it's going to get approved. Because it is right next to an existing cemetery. There's no environmental sensitive area, and it has cemetery rights already. So we opted for the latter, and because that typically is a 3 to 6 month process. We're already in that, so we should be back on site there around roughly around May, June next year. Sort of as I'm gonna call it as a worst case scenario. I'm hoping sooner. And then once that comes online, I think there's good scope to get to that level. And then from there, I think the intention is to look for more parks. We first want to get Rustenburg off the ground. Always said, because your cycle is so long, and because we've got so much of stock in that business still available, let's get Rustenburg up and running. Let's make sure it is profitable. Let's make sure it's successful, and then you go into the next one. And so we'll build out the portfolio and hopefully start adding parks throughout the country, just to have that national footprint as well. But there's quite a lot of scope in that business still.
You've been terrible.
Yeah, no, okay.
There's no we.
No, it's still a week.
So I think we've got time for maybe one more question, and I want to ask it because it's an important one. So just looking, I've had a couple of questions in my DMs around big risks that keep you awake at night, but also around debt and the balance sheet and, the borrowings. I was looking on your financials now. You've kind of got a variety of notes over the next couple of years. You've got some term loans out to 2028. I mean, it's over R1 billion total debt. There's some refinancings coming up. I guess to the extent you can talk about it, just the quality of the conversations you're having with lenders or potential, sources of debt capital. I would imagine that given where you've got into as a business and where South Africa is right now, it's probably relatively high quality conversations, because from others I've spoken to, there's more money right now in South Africa than there are assets to invest in or lend to. So hopefully you're on the right side of that equation.
Yeah, so firstly, you'll see the debt has increased to 100 million, and I think earlier I said it decreased to 50 million already in September, and it will decrease with another 48 million end of this month, which takes it back to that 950 million level it was at 28 Feb 2024. So from the cash from operations, we managed to take that back. I believe that Calgro and its capital structure always need a fair amount of debt. There's actually some of our shareholders that believe we're currently too thin on debt. I'll rather be slightly too thin on debt in good cycles and slightly too heavy on debt in bad cycles. So that's where we get to. If you look at the 0.63 net debt to equity, and you keep it roughly, say, under R1 billion or roughly R1 billion worth of debt, and your profits grow annually, which you only pay out 5% in dividends, your net debt to equity actually come down quite quickly. Further than that, you'll see if you value it to the REIT's valuation, and that's how you value it to the assets, it's only on a 30.4% LTV, which is actually the target range for most of the REITs. So we don't believe the group is overgeared. We believe that as debt come up for maturity, we'll be able to refinance it, to the tune of that. We currently have a term sheet for 150 million. We had for the last 4 months, where it's just one term, which we don't quite like. So we haven't been able to, we haven't been forced to sign it because we don't need the money at this stage. And I think that's where you're correct. There's currently more money in the system than what we can take. And one of our non-executive directors always have this saying, don't be seduced by opportunity. So currently we're not seduced by taking on more debt. We'll keep it at a stable level. However, so there is one but. Going into Bankenveld, it's a new project. We've done lots of environmental studies, lots of geotechnical studies, but there will be one or two surprises in terms of the ground conditions, because you don't test 100% of the ground, you do test holes. And we generally do more than what's required, but it's still a test hole, so that you will be surprised. We hope we're not, but we'll most likely see undisclosed graves. And then you have to move that, and that comes with delays. For other developers, it comes with 3 to 4 month delay. In Calgro's case, because we've got a business that specializes in it, I need about a 4-week delay, but it still comes with delay. So we'll need backup capital. So for that reason, we are going to raise most probably 200 to 300 million in backup facilities, will remain undrawn, and if it have to be drawn, we'll draw it and separately invest it, but just to cover the risk. So the intention from a net debt to equity perspective is to stay where you currently are, keep the debt roughly at that levels. We believe it's serviceable. We believe it's under the market norm or on the market norm, and we don't see the risk in that. So that's not what's keeping us awake at night. And capital is currently freely available. And the other thing is, if capital is freely available, and you can take it and you can invest it with similar returns so that the negative carry is not too much, it's easier to do that than to try and look for capital when you need it, because then generally no one wants to give it to you. I hope I answered your question.
Yeah, that did. Thank you. We're out of time. To those who, I think we got through most of the questions. There were maybe one or two we didn't quite get to in the time we had, but I just wanted to wish you both, Vikas, Valdi, all the best for your, future ambitions. Thank you for being such strong supporters of what we're trying to achieve in Unlock the Stock. I mean, you've been on several times now. Ben, Pierre, Siri, we look forward to doing many more of these with you. So thank you. Well done to all of you. And yeah, appreciate the support.
Thank you.
Thanks very much.
Thank you to everyone who has spent this or chosen to spend this time with us today. And a special thank you to Vikas, Sari, Baldi, and Ben Pierre for making the time to support Unlock the Stock, as the Finance Ghost said. So thank you very much for that. We hope that everyone on the call has enjoyed this event. And if you want to listen to it again, it'll be on the Unlock the Stock YouTube channel next week. Our next session will be in November on the 21st, and that's going to feature TWK, which is another returning company. And then on the 5th of December, we have a new company joining us, KAL Group. So we hope to see everyone on the session again. Thanks to the management team again. And from my side, that is all. Goodbye.